Well, we should probably start with introducing yourselves and what you do, especially in relation just to the idea of a Bitcoin treasury.
Yeah, I'm Jay Beddict. I'm a director at close you. Is it? Sorry, Jay Beddict. I'm a director at CleanSpark's digital asset management team, and we are a Bitcoin treasury shop. So we do treasury.
I'm Rob Hamilton, co-founder and CEO of AnchorWatch. We do Bitcoin custody and insurance for that Bitcoin.
Joe Kelly, CEO and co-founder of Unchained. We do Bitcoin financial services, help people secure Bitcoin holding their own keys, and have a trading desk and do loans, secure loans against Bitcoin.
Yeah, to me, the whole idea of the treasury company, they got monopolized by the companies that focus on, publicly traded, highly leveraged companies focused on their treasuries. But to me, that any company that has Bitcoin in the treasury is a Bitcoin treasury company. Every family should be a Bitcoin treasury company too.
Agreed.
So, um, given that, if we look past some of the just, that sort of broader, Bitcoin treasury company stuff that we see, as Rod was saying, you're a company, you get your hands on Bitcoins. What do you do next? What are the most important things to do next with custody, insurance, financing, accounting? What is the next step?
I can kind of start as I think the root is custody or how it's secured. And so you have options. Obviously, you can go to a centralized custodian and a lot of name brands that are out there, or you can hold your own keys. Services like Unchained or AnchorWatch and others that have an implementation that I think was one of the challenges you do come with once you start trying to hold your own keys is how do you account for this or how do you account for it in ways that your attorneys and your accountants and your board understands. And so even just some of the simple things that like an Unchained account offers, like a PDF, a statement with a logo, a financial institution on it that attests this Bitcoin belongs to this entity. So especially if you're dealing with complex entities or complex ownership structures, that you need to be really clear and careful about where Bitcoin lives. That's just kind of one thing to be aware of that is available to you even as you decide to self custody rather than use a traditional financial institution.
Yeah. To add to that, 1,000% custody is the foundation of any other financial service, right? And you can look at it for Unchained. Your ability to offer the loan product was built on your ability to have your own custody infrastructure. For us at AnchorWatch, having our own custody infrastructure enabled us to do insurance. And it is really the foundation of being able to do anything else. And if you're thinking about having Bitcoin allocation on your balance sheet, uh, where those Bitcoins are being held, the rights to how they can be moved around. Are you directly holding keys? If you're not holding keys, what is that relationship with the end customer? We've seen some of the stuff recently with the Prime Trust bankruptcies that there was a lot of complication where you were being told that it was being held in escrow. But if you actually look at the legal opinions from the bankruptcy proceedings, the phrase that I took away from it was hopelessly commingled was the judge's actual word in verbatim in the opinion saying that this massive aggregated omnibus solution. I know, like with Unchained, each customer has their own vault, right? Each loan has its own address on chain, right? You have a better way of doing that. Same thing with us and our customers. And if you are a counterpart, if you're a larger institution, maybe there's one on stage that can talk about what does it look like. You have to hold your coin somewhere. Being able to set up these relationships properly so that your Bitcoin is yours and it's sitting right there. And that provides a very clean ability for you to have access and governance over it.
Yeah, and I mean, I'm just going to say the same thing as them. Custody is the foundation, right? This is a bearer asset. Not your keys, not your coin, but extend that to fiduciary obligations that you have to your shareholders. Custody underpins all of it. And to Rob's point, selection of custodial partners is really important, especially for what we do, right? So you talked a little bit about uh, when people say treasury company, they think of someone who's highly exposed to Bitcoin and available, in public markets, right? That is a business model that exists. It is not
That's a
Bitcoin
business model.
treasury.
Are you sure? It is a
Air
thing.
quotes. Yeah, it exists. Now, when I come from traditional financial services. Despite my spooky appearance, I do have my Patagonia vest, so a man of two worlds. But in traditional business, traditional institutions, treasury management is risk management. It is preservation of capital and hopefully optimization of profits as well. But it is in service to a a business, right? And for us, we're America's Bitcoin miner. We're expanding into AI HPC, but we have Bitcoin coming in. And then we're able through the Treasury function to manage that. But we have to do that with the right custodial partners. For us at scale and as a publicly traded company, we have to be incredibly selective with that custodial relationship. There are certain controls, right? Like Joe mentioned, that like just it's a non-starter. We can't run around with a Trezor or a cold card. It's just not. You don't do that. So there is some third-party exposure in that. There are really good custodians like on stage here that have a lot of tools to enable better use of Bitcoin and take advantage of some of the native properties to it. There are more traditional custodians that will fully control it on your behalf, and if you're comfortable with the legal language there, you can get comfort with that. But I think there's a lot of evolution in the custody space coming that I think is going to be really impactful to how a true treasury function is going to operate on a Bitcoin standard.
Yeah, I think that's it's an important point that when people get into Bitcoin, they're obviously they think about it the purest way, which I fully support, and I think people should have the purity in their heart when it comes to Bitcoin. At the same time, it tends to be around a meme of the sovereign individual, and so yes, you can have your your cold card, or you can even carry around the Bitcoin in your head if you really want to be crazy or something. You can do that. But obviously, when you're working with other individuals, whether it is a family or you're growing to the size of something like a giant public company, you have a lot more variables you have to deal with, and like you said, different risks. Could you talk more about like what is it that needs to be addressed, and in what ways, like you say right now, oh, we can't use a cold card. Is there a future where there are ways that you can incorporate more cold cards into that because certain things develop?
Yeah, I think again we've got. I'll let them go into the technicals because they're going to be way better and more interesting than I am. But there's a lot of evolution coming in the custody space right now, where like our risk tolerance, right, as individuals, as Bitcoiners, is relatively high, right, compared to an institutions. And so, if you can tell, I'm a little bit paranoid. So like, I don't want to hold a cold card on behalf of an organization. Like that's just a lot of risk to put on an individual. Um, but I think what we're going to be seeing is custodial providers that are going to leverage Bitcoin's native properties. There are, custodial providers today that exist that are of massive size, and they just treat it like any other asset, right? You can move it around, and they have existing controls and their homegrown software, what have you, and that's all well and good. And to be frank, that will get your auditors happy. It'll get your risk managers happy because they're used to those custodial relationships. There's a lot of well-trodden legal paths for that. I mean, we're still learning some new legal stuff with this prime trust thing, which is interesting, and I think that'll inform new custody decisions. And like for me, as someone who assesses risk, any custodial relationship, I better believe I'm gonna be digging through, their agreements there. I think for one of the things that we really look for, we actively manage our Bitcoin treasury, and that means that we have to, have counterparties. And there's, when you're trading on derivatives or things like that, like there's additional custodial requirements and considerations that like a Coinbase or an Anchorage or Copper, whoever, like there's really specific things that they might not be able to do as well as we would expect, or it's holding back certain derivative products and stuff like that. So there's so much room for growth on that side.
I just imagine having to be the guy that holds Michael Saylor's 820,000
I do
Bitcoins
not envy that,
on
man.
a cold card.
100%.
Make no mistakes.
I would even say as the jumping off point, like from either a corporate treasurer, even as an individual, a tool of risk management is risk distribution. And that means you don't have to have all of your assets in one place, right? You could have different tranches of capital that have different expectations of how hot or cold they are. Michael, to your question around like, do we get to a place soon where someone could hold a cold card and be able to interact with this stuff? I think we are already starting to see that being there. For what we do at AnchorWatch, you can hold keys and we hold keys, and your keys can have contingencies where even if you were to lose the cold card in a flood or a fire, EMP, or 1,000 other horrible things, or a wrench attack, all of these things, you can leverage Bitcoin in a way where those could be destroyed, but you still don't lose the underlying asset as a starting place. That's how we were able to structure our relationship with Lloyd's to do Lloyd's of London, as a Lloyd's of London cover holder, to do the insurance for the Bitcoin. And that as like programmable money, you can have it operate in many ways. You can't have your bank account say, well, if the money hasn't moved in 6 months, this login now is able to access and move the funds, which is kind of what you're talking about on this key hierarchy and structure. So I think those are all like interesting things. I think another thing too, just talking about the asset, before talking about segregating of funds, I think there is a reasonable middle ground if you have a big omnibus account, right? If you are Coinbase and you have a 10,000 Bitcoin wallet, like address that is holding for a bunch of different customers, BitMEX started this, and then River like built on top of it, and I think is really championed now with proof of reserves. If you're going to have an omnibus aggregation, it's just incumbent on you in these prime trust bankruptcies. You're actually seeing what it looks like in their own self-described documents. 80% of the time, they were under collateralized in their Bitcoin account.
That's extremely bad.
Right. And this goes to talk about like, having just saying that you are a trust company is insufficient. Always with technology, you're going to be a decade, if not further ahead of the laws and the regulations. And these things were not originally designed to be vehicles for digital assets. Trust companies have existed for centuries. But this is now, think about how to champion that and put the best foot forward. Things like a proof of reserve would be a very trivial way to start somewhere. Sure, it's not perfect, it's not a panacea, but it is better than not disclosing anything and then waiting for the company to go bankrupt and then find out, oh wait, you didn't have your Bitcoin most of the time anyway.
Yeah, makes sense. I still just have the prime trust thing in my head, because it's like wait, I got the Bitcoin out, and then but there's still a legal claim to them, or just that. I mean, how much better would it feel if you were in self custody that whole time, where you just know you're holding the asset. So, but I think for a lot of these things, I do think about it. There's the challenge of ease of use, adoption, understanding of these ideas. It's companies like us that are trying to work on that, make it easier to use kind of problem, and then longer term, it is it's a game of patience, because people need to learn about these custodial failures or learn about this prime trust kind of case study for it to, I think, really, really matter and make sense. And I think for this conference, especially this audience, I think miners are actually a place where we see a lot more of the readiness and willingness to lean into self custody. Maybe not so much always on that public scale, or when you have other concerns and considerations, but just because they're usually already tactile, like working with the physical miners, physical infrastructure. There's Bitcoin being mined in different countries, or there's just kinds of problems that having a base layer use of the asset makes a lot of sense.
Well, I was going to say, I mean, miners, are the sort of ideal Bitcoin treasury. They're net inherently long Bitcoin.
Yeah.
And so, like, from a treasury management perspective, they're gonna have custody sorted. They're gonna be discerning in their custody partners, I should hope, or they should be. And then on top of that, when you're trying to manage the stack of what you mine, you have to pay out your ops, your employees, all this sort of stuff, cost of power. But you're long Bitcoin, short dollars. So then you can start to play on the derivative side and sort of try to maximize that and squeeze out as much value as you can, whether it's in sats or dollars, depending on your functional currency, and philosophical mindset. But I think that's a really important point to this is extremely relevant for miners because you are long Bitcoin.
Yeah, all Bitcoin originally came from a miner. Right. So every single Bitcoin, anyone who holds Bitcoin in this room, originally a miner brought that into the network, and they were the first one to custody it before it went somewhere else. Right. So they are just naturally primed as the one that's, if you've almost like the Cantillon effect, the flowing of the dollar, the flowing of the Bitcoin comes from those miners, and it's a better system.
Effect.
It's a better system because it has the proof of work, right? They're not just calling up the Federal Reserve and just making new dollars exist out of nothing. But that's why I think they are the best person to think about that, and they're at the forefront of all of the Bitcoin ever being issued. So they're definitely I think the special business use case, particularly for being exposed to holding it yourself.
Continuing on that with miners, are there other things where you think being a miner specifically makes you very different from just a typical company who might be just trying to acquire Bitcoin to put it into a treasury? And are there places where that ends up kind of coming into conflict in some way?
I don't know about conflict, but I think one of the unique things about being a miner, right, is you have an operating business that prints Bitcoin. And for us to manage that risk, right, we have an operating business that prints out Bitcoin. we have a functional currency for our, financial purposes, USD. There's a gap there, right? And there's a spread. Someone's gonna want to trade that. And that's something that, on having, the appropriate custody partners to build on top of, we can then take advantage of that difference, right? So, like I was just alluding to, we want to pay our, suppliers, pay our employees. They want USD, or we have fiduciary obligation to pay in USD. So converting Bitcoin to USD, you can go spot, or you can do better. And we try to do better on that for our shareholders, for our employees, and that's an advantage that miners have, because you have a cost of Bitcoin below market. Generally speaking, if you're mining Bitcoin, you're probably spending less than whatever the current market price is to acquire that. So your basis is different, and then you can leverage derivative markets that are evolving, right? I think that's another thing, and maybe that's outside of scope of this conversation. But we're seeing a real maturation on the financial market side and capital market side that allow a Bitcoin producing business to take more advantage of that, to better manage their risk, their FX exposure, and then I think that's a huge advantage that Bitcoin miners have.
I would just add, if this is something that's interesting to you, What Bitcoin Did by Danny Knowles just had a podcast with Harry Sudak and Rory Murray from the CleanSpark team, and they just spent an hour and a half talking about this. So like, if you want to go deep and learn more about that, it was a very great podcast. I'd recommend.
Highly recommend.
So with all this, there's been a couple different companies and business models that have gotten some feelings from here on stage. For the capital allocators and sort of CFOs who might be thinking about this, is like, well, what does a credible treasury strategy look like that you would actually have less feelings for negative feelings towards, and are there cautionary tales that haven't been told enough yet that we need to be thinking about beyond just what you were saying with prime trust? Are there other important cautionary things that people need to watch out for?
Just one that comes right off the top of my head. A lot of the very large players in the ecosystem at these custodians have preferred liquidity things. So if there was ever an insolvency or an issue at an exchange, the very large holders of Bitcoin actually get preferred liquidity tranches in the event of a bankruptcy, and they kind of negotiate that as part of their large enterprise agreement. So understanding where you are in the capital stack, if there is an insolvency event, I would say is just massively critical if you're like doing your due diligence on your vendors. As a general point, they usually point to some shared insurance policy, but those are very limited. When you look at Coinbase having $300 billion of assets under management, they have a $300 million policy. So yes, there is insurance, but that'd be like if I was, and everyone claims that same insurance policy, but that'd be like if me and everyone on my block shared the same homeowner's policy, but it only covered the value of one house. Like someone's going to be shortchanged in haircut on the way out. So those are just a couple things in having conversations for like large. If you're picking a custodian, understand where you're on the capital stack. And it goes back to Joe's original point. If you're holding keys and there's segregation on chain, like that is a much cleaner relationship where there's not this omnibus monster you have to try and navigate through.
Yeah, I mean, again, going back to custody, right, and the risks that can happen in a functional treasury business, right? So we trade with counterparties OTC for Bitcoin derivatives, known, public. There is a thing called margin, thing called leverage. That's very dangerous, right?
That's a business model.
But again, it's a matter of being disciplined, right? Like there's a goal with our risk management strategy, right? We serve an operating business, right? It's not chasing, returns or anything like that. So in my perspective, it's really being as disciplined as you can be in that, right? Our job is not to gamble. Our job is to hedge risk. That's, sometimes people conflate the things. The derivatives and leverage. No, like these are tools to a disciplined, allocator and capital markets participant that can be leveraged for your advantage. You don't want to get greedy. You don't want to be foolish with that. And I think, we've all been in the Bitcoin and broader crypto space for a while. We've seen people get eaten up on leverage. I think, with some of the other treasury strategies, I think they're, jokes aside, they're looking at, building broader operating companies, and we're kind of coalescing on the same model. Berkshire Hathaway, I think, was thrown around yesterday, right? Where you have these operating businesses that sort of play off one another, and then you have a capital markets, element to that as well. And I think that is something that's durable. We've seen it in the broader market. I think one thing, having been involved in this space for so long, we're still relatively naive. There are existing solutions to the problems that we have. We just haven't had exposure to them, or those folks who have had exposure haven't come into our industry. And I think we're starting to see, especially on the financial market side, that maturation. And there's a lot of ire in the Bitcoin community around like credit and this, lending and DeFi, right? DeFi outside of Bitcoin, I think is rightfully maligned. But if Bitcoin wins, right, Bitcoin's programmable money in a limited sense, and I'll let Rob espouse on that. But ultimately, like, it's better money, and that means that there are tools that we have today that we can leverage in a primitive form with very basic custody structures. But as custody evolves, we can leverage Bitcoin to manage risk even better. So yeah.
A sense that I get from the whole thing is that the common adage in Bitcoin of stay humble, stack sats applies not just to the individual, but any organization that is operating in Bitcoin. And it sounds like basically, for some of these people who are on the sidelines, like, which implies they kind of want to like get in, is that's where you start. Like, you don't even think about these other things yet. The first thing you do is think about, how do I acquire Bitcoin? How do I acquire Bitcoin that I can actually hold on to? And now that I can hold on to it, how do I know that I can hold on to it in confidence so that you don't lose it? And then and only then do you start to explore, are there specific kinds of capital structures that can improve where you are, but stay humble and at least start with that first part of like actually having the sats.
Yeah, like you need an arbitrage or you need something that at least in the CleanSpark example, it's like there's a known quantity of Bitcoin being produced every month. So that reduces the probability space of any derivative or other things you put on to have this known input that then you can kind of trade around and adjust your strategy around. And so that is where I think that those models really couple together well, to actively manage strategy plus having that fact. And so you need some sort of something flowing. Something has to be flowing your way that touches some leg of these products you trade on derivatives, and then it starts to make sense. I think it can be done more safely or more soundly on more certainty.
Yeah, I'd even add to like just for, we're talking about like whether it's derivatives, covered calls, all these like financial options. I even think just like the simplest one really is just a Bitcoin backed loan, right?
Yeah.
And if you're on, maybe not on the Bitcoin side, just on the capital side of the business, as pristine collateral, like 24/7, 365, billions of dollars an hour. I'm not, what's the daily volume for Bitcoin? Is it like it's over 100, like 50 billion or something like that? Like highly liquid. The ability to, like, I don't think Unchained's ever had like a loan execute. Like, you've been
No
able
loan
to
losses. No.
no loan losses, right? So think about that from just the strength of the capital and the length you guys have been in market to be able to show and demonstrate that this is a reliable, tried, tested, and true use, and it's something that only really could be done the way that Bitcoin does things, right?
Yeah, I think that's a really important point on the credit market side. Like, that is the most primitive way of doing it, but we often hear yield being thrown around as a bad word, right? But yield is money in motion, right? So Bitcoin on my balance sheet, I have nothing to invest it in. I have nothing to build out, deploy it with. But somebody else is willing to pay me a percentage to leverage that, to borrow from me, promise to pay me back, promise to pay me a coupon over that time. That's an ancient business. It's not going anywhere on the Bitcoin standard, but Bitcoin allows for, I think, better credit. Ultimately, again, the 24/7 deep liquidity is a huge boon, because it's not, oh, it's 5 o'clock on a Friday, I have to wait until 9 a.m. on a Monday or whatever to get this sorted.
Memorial Day, so we're Tuesday.
I'm sorry, you're
It's
right.
Tuesday,
That's right.
yeah.
But I mean, that's serious, right? I mean, where if you have an operating business and you have to wait 3 days for cash,
Yeah.
and you have a thing that you need to fix now, you're going to have to go out to some other weird esoteric credit market to go and source that in time if you can't get it. So yeah, Bitcoin, I think, Bitcoin fixes this.
Yes, as long as you can confidently answer the question, where does the yield come from?
Yes.
Right. That's just on the yield point, like capital in motion or just productive use of capital and earning a return. Earning, like, taking your time in a way is like Bitcoin yield, right? You take your time, you take your paycheck, you put it away in there. If you're doing Bitcoin today, like denominated financial services, if it's productive and it's something that of value, it will necessarily accrue a yield. And the yield is not coming from like dog coin tokens, right? It's coming from people using Bitcoin as a true capital asset. And I think that's kind of something that's uh, on the custody, like as the technology and like all of this like programmable, but really it's capital. It's just better capital and just viewing it in that sense. And I think that's part of the maturation. I think with the Treasury company story, everyone's jumping on that and everyone wants to say they're going to be the next like Berkshire, or they're going to do the next X, Y, and Z. That just means that you're running a decent business that just does big things in Bitcoin, right? And mining is a perfect example of that. You take electrons, you turn it into Bitcoin, and you're able to do it better than anyone else in a global market. You're providing a service to the network. You get compensated for that. It is a way of earning yield.
100% agree.
All right. Well, I just want to open it up if anyone has sort of final questions and suggestions for those who want to start or grow their Bitcoin treasury.
Read your custody documents.
Yeah, read your counterparty documents. Also, just understanding having a long-term strategy for it. This shouldn't be something that is done flippantly because you'll be trading out at the first wick. It should be something that's very structurally done. Maybe I'll be heretical and say prices that you would hedge out of your position. Like, what is your position relative to your overall portfolio? It's not what I would personally do, but the reason why that's why I'm not the CFO of a successful business is because I'd keep it all in Bitcoin. So, like, you want to be mindful and like have your strategies and have it really clear out, execute, and maybe like once a quarter, once a year, review those like primitives. If you're holding keys, regularly health checking your keys, having recovery protocols. Even as individuals, you don't want to have a treasure map strategy. Whatever you do, don't have a treasure map strategy. Don't like you don't have to use our products, but like literally just have something that is better figured out than I like this guy on a podcast. So I'm just gonna if I die, wife, you should go reach out to him. Like you never want to be in that. Like I've had people reach out to me, like widows and people who I didn't have previous relationships with, and you just want to have really safe upfront security protocols, whatever you're going to do, no matter what.
Yeah, take the time to get it right. Yeah, hard to add much more to that.
Yeah, I was a little facetious in my answer, but it's discipline too, right? When you undertake a treasury strategy, right? I like Bitcoin. I don't want to sell it. It hurts to sell it, but it's for a purpose, right? Ultimately, when you're running a business, it's just a cost of capital. Like you need to treat it for what it is, and it's better capital. And so being able to have a plan, like Rob said, and then execute on that plan mercilessly, right? Like that's you said it. It's not set and forget, right? Market conditions change. You need to be ready to handle that. But the old adage of like, I'm mining to stack sats. Like, yes, absolutely, you are. But putting them in cold storage and not using them is bit of a waste, right? You could be doing more. You could be doing better on that front, and that takes kind of breaking that mindset.
Yeah, I think it also goes back to the whole context of a treasury company. Like you as an individual will have necessarily a different company and also different obligations, right? If you're within a corporate organization and structure, right? That changes from a fiduciary standpoint. Your duty is, even if your corporate mission is to get as much Bitcoin as possible, right? But even if you're just a regular business, your first duty is to advancing the interests of the shareholders and doing what you need to do right by the business, right? And that's where in your philosophy and investing in it matters. How it's custodied and managed. Like, I don't do this, but maybe I could keep my life savings in a cold car in a sock drawer somewhere. But that is different if it's my own personal problem versus a fiduciary responsibility to my company. And you want to be able to have platforms like what Joe said, like you want to be able to go and get like set attestations and documents that help with your counterparties and with your auditing. Like it's a whole different level of compliance too, of like rotating out account holders. You want to be able to maybe have your auditor be able to view the dashboard and look and see like the Bitcoin is sitting there, maybe giving them an address. Like when you're dealing with counterparties, which is what happens the moment you leave self-custody, you want to have this like scaffolding and support to be able to better traditionally interface with the larger financial system. And whether it also like just estate and continuity planning, right? Continuity, like it's always estate planning for you as an individual if you were to ever die, but on a corporate governance side, you should have a continuity plan. Let's say if the CEO leaves the company and goes somewhere else, right? You want to have full continuity and uh, around the strategy of how that treasury like persists and continues. So like these are all things that platforms can help you facilitate in that role, and you just got to make sure you understand that all of your needs are being met when you're making that selection.
Excellent. Well, thank you guys so much for sharing this.